Hello, and welcome to our very first Pulse Check. I am Scarlett Hall, Marketing Director for Pulse Financial Services, and I am here with Andy Umbach, one of our financial advisors. Hi, Andy.
Hey, Scarlett.
I am so excited to kick this off today. It really is a perfect time to do so. With this being our first Pulse Check, I just want to quickly take a moment to set the stage for our audience. This is something that we're going to be doing, maybe quarterly or semi-regularly, depending on what's going on, just to kind of check in with our advisors on, what's going on in the markets, different hot topics, things that are affecting investors. And we'll just ask them, what's going on? What are you hearing? And get their insights on different key topics of the moment. So, as always, everyone's individual situation is unique, so we will be painting with a little bit of a broad brush. But none of this should really be considered direct advice for your individual situation. But as always, don't hesitate to reach out to us at the office or send over an email, and we can be sure to get your specific questions and needs addressed. Okay, so let's check in. What is on people's minds today? We're hearing a lot about market volatility. With the recent pullback in markets going into correction territory, it's creating some questions for investors.
Yeah, there's certainly a lot of uncertainty right now. The markets are reacting, investors are feeling concerned, and that's totally understandable when things are feeling unpredictable. It's natural to have questions.
Yeah. So tell us then, Andy, how should we be thinking about all of this?
Well, great question. And, first, it's important to remember that volatility happens. It's the price we pay for being investors. As you can see in front of you, market corrections are a normal part of investing, and they actually happen more regularly than most people realize. And when you're in the middle of one, it feels really big and impactful and historical, but markets, rebound multiple times throughout the year. And in fact, about a 5% decline of the S&P, going back to 1942, occurs about 3 times per year and lasts an average of, 39 days or so.
Wow. So this happens more frequently than maybe people realize.
Yeah, it does. And, sometimes we get lulled into a place of comfort when we don't see a correction happen. Like last year was a pretty calm year for the markets. And so when we see something like this happen and it happens so quickly, it can certainly rattle our cage a bit.
Sure. So what kind of thing happens to cause these types of corrections?
Well, when we ask what's causing this, there's certainly a lot at play. We have political events, geopolitical tensions, economic shifts, tariffs. Some of you may have heard of tariffs, and all these can create these short-term uncertainty. But if you look at the history of the markets and all that it's been through before, this is one of our favorite charts. It shows the growth of $10,000 based on the S&P 500 index performance over the last several decades. And while many people would say this time is different, and certainly that's true, or completely unprecedented, like unprecedented seems to be one of the favorite words to be used. The market has shown overall resiliency through major crisis, unprecedented events, and sometimes taking a step back and looking at a chart like this can help you gain some perspective. And the key is to having a strategy in place that keeps you focused on the long term with those long term dollars, which helps you keep the emotions at bay. So then you're not making emotional decisions.
Yeah, wow. Thanks for sharing this. This chart clearly does kind of illustrate that big picture and why it's so important to stay disciplined. And definitely not react emotionally, as you said.
You're exactly right. And this is one of our favorite charts too, is humans are very emotional. One of my favorite college courses was behavioral finance, and it just showed the type of decisions we make, thinking that we're making good decisions when we're actually not. And over the last a couple months ago, we were looking at people feeling somewhere in here. They were feeling thrill, excitement, maybe even euphoria. People want to take on more risk with their investments than maybe what they were historically comfortable with. And now we've gone through this downturn, and now maybe we're feeling somewhere in here, and people want to start, reacting emotionally. And so it's really important to protect ourselves from emotional decisions.
Yeah. So when should people make adjustments to their strategy?
You know, well, it's probably they people probably should not be making decisions when there's a steep and quick market decline. Two questions worth asking yourself when you feel like you want to make some changes are: has my risk tolerance changed? Has my time horizon for needing this money changed? the reason to have a strategy or a plan in place is to protect ourselves from making emotional decisions with your money, which usually end up poor. Adjustments should be made when your personal circumstances change. You have different life events like a job change, retirement, a new child, or other major unforeseen expense. That can maybe call for a reassessment of your plan. But reacting emotionally to short-term market movements is usually not a good reason to adjust your strategy. In fact, the strategy exists to help you navigate through these periods of uncertainty. And then, it's important to revisit this regularly with your advisors, and that's really important too.
Yeah, absolutely. So can you tell us what exactly is going on with the market?
Yeah, absolutely. And this chart we review with a lot of our clients too. Stocks were very expensive. So this kind of shows it's called the PE ratio. This shows when stocks are really expensive. This shows when they're average price, and this shows when they're cheap, right? And so when do people tend to buy stocks or want to buy stocks? It's the opposite of everything else we consume. People want to buy stocks when they're really expensive like this. And this is like the dot-com bubble burst over here. So you can see, history doesn't repeat, but it often rhymes. And so we were at a very expensive part of the market. And now with this, recent turbulence and talk of tariffs and everything else, we've let some of the air out of that bubble. So the good news is, stock valuations have come down. So we're let some of the air out of there. So we're looking at, more reasonable valuations currently. But what caused that? It's a number of things throughout history that can cause these bubbles to burst a bit. But late in the week, global stocks made it clear that the tariff announcements were worse than they expected, and we were looking at roughly a 10% effective tariff rate. And once all the details are parsed, the actual figure appears to be closer to 20%. So that's about double what the market was expecting. And when the market gets surprised, the market tends to overreact to some of these surprises. Panicked investors are trying to decipher what to do next, which often leads to missteps. And there's very reasonable arguments that the current shift in trade policy could fall into a different category. But really, any sort of positive news or a positive tweet could have, be a catalyst for things to improve and start trending the other way. And really, even if we knew for sure if the U.S. was either in or heading for a recession, it would not necessarily make a prudent strategy to get out of stocks or make any adjustments to your plan. And the fundamental problem with that decision is investors don't know when to get back in. And that's part of the dilemma to complicate things further. And if we think back to like the COVID-19 pandemic, there were some big sell-off days back then, like March 6th of 2020, the S&P was down like 7.6%. March 11th, it was down another 9.5%. March 13th, it was down almost another 12%. So, and some may find it difficult to remember these incredibly steep declines one after another, but that's exactly what the market did. And then it recovered quickly thereafter. And even like, the news cycle tends to really lag by many, many months, the market recovery. So stocks actually started to surge in 2020 as the unemployment rate was still double digits, very high. The vaccine was still 9 months away from being approved. There were hardly any green shoots to be found anywhere, but the market started to rebound at that point. And that's part of my point is that when we're trying to guess when to get in and when to get out, those are very difficult decisions. And this chart here shows that the impact of missing the best days. And so this shows that if you invested $10,000 back in January 1st, 1980, and you held it all the days, you have $1.6 million over this time horizon. But if you missed just the best 5 days, just 5 days out of all that, you're at $1 million, which is still a lot of money, but you left 600 grand on the table if you missed the best 5 days. So the bottom line for investors is, the market's response to the tariff announcement was very unsettling, and I empathize with the challenges and the stress that this causes for investors. But the markets are unpredictable day to day, with a 50-50 chance of a gain or a loss. But over the long term, you're going to do well in the market, and you want to stay invested. And you want to make sure that your strategy has you appropriately allocated so that the money you're not touching for a number of years can stay invested to grow and navigate these downturns. And the money you might be needing in the shorter term is there for you and not impacted by these declines.
Wow. All right. Here's the beat. Market volatility and corrections are a normal part of investing, and history has shown the market's resilience through countless crises. Rather than reacting emotionally, we need to stay focused on our long term strategy. Recent pullbacks are helping to bring valuations closer to the long term averages, and selling out of the market today substantially increases the chances of being whipsawed when a rally does decide to take hold. So, does that sound like
You're,
it, Andy?
you're exactly right. And again, this is why strategy matters. Knowing your risk tolerance matters. Knowing your time horizon matters because it can become emotional, and the emotional investors are the ones that generally underperform. So that's why having a strategy in place. If you don't need this money for a very long time, you can ride through these periods of uncertainty. The money that you're going to be needing sooner than later, hopefully that's in a nice, safe, stable place that isn't fluctuating very much.
Amazing. Thank you so much, Andy. That is it for our very first edition of Pulse Check. If you have any questions and want to talk through your specific strategy or situation, we are here to help. Thank you so much for tuning in, and we look forward to doing this again soon.